January 21st, 2026, 10:14 a.m., New York. While the financial news networks were busy celebrating another record high on the S&P 500, preaching the gospel of a soft landing, a silent order was executed deep within the digital ledger of the SEC. It wasn't an algorithm gone rogue. It wasn't a retail trader panicking. It was a manual, deliberate override from one of the most powerful offices on Wall Street. Richard Kushel, Senior Managing Director at BlackRock, the man who helped steer the ship that owns the world economy. In a single keystroke, he didn't buy. He didn't hold. He dumped $22.5 million worth of stock. Gone. Converted to cold, hard cash. At the exact same moment, miles away, a director at M&T Bank was quietly liquidating nearly $4 million of his own position. They tell you the economy is robust. They tell you to keep buying the dip for your 401k. Yet, the architects of this system are quietly rushing for the emergency exits before the music stops. Why now? Why January 21st? And more importantly, what do they see on their terminals that you are not allowed to see on yours? The smart money isn't just moving, it's leaving. To understand the gravity of what happened on the morning of January 21st, 2026, you first have to understand the noise that was designed to distract you from it. For the last 6 months, the financial media complex has been singing a single, harmonized chorus. They call it the soft landing. They point to the consumer price index stabilizing. They showcase unemployment numbers that seem perfectly managed. They bring out smiling analysts who tell you that the Federal Reserve has pulled off a miracle, threading the needle between inflation and recession. The message is clear, comforting, and omnipresent. Buy the dip. Stay the course. The worst is behind us. The American economy is bulletproof. But while the cameras were rolling and the pundits were popping champagne, the printer in the compliance office of BlackRock was spitting out a document that contradicts every single word of that optimistic narrative. It is a document known as Form 4. To the untrained eye, it is just administrative paperwork, a mandatory disclosure filed with the Securities and Exchange Commission. But to those who know how to read the language of the elite, it is not a form. It is a siren. The name on the filing is Richard Kushel. He is not a junior trader. He is not a mid-level manager speculating on a quarterly earnings beat. Kushel is a senior managing director at BlackRock. He sits at the very top of the food chain, inside the machine that manages over $10 trillion in assets. This is the entity that has been jokingly, yet accurately, described as the fourth branch of government. They do not guess what the market will do. They arguably decide what the market will do. They have access to data flows, government whispers, and liquidity maps that retail investors could not see, even if they had 1,000 Bloomberg terminals. On that Tuesday morning, while you were likely checking your 401k and feeling good about the green numbers on the screen, Kushel executed a massive liquidation. He didn't trim his position. He didn't rebalance a small percentage for tax purposes. He unloaded 20,000 shares of BlackRock stock. The transaction value was $22.5 million. Let that number sink in. $22.5 million pulled out of the equity market and converted into cash in a single day. If the soft landing is real, if the next decade is poised for a golden age of growth, as the headlines suggest, why is one of the highest-ranking executives at the world's largest asset manager cashing out right now? Why is he running for the exit at the exact moment the public is being invited to enter? This is where the anomaly deepens. If this were an isolated incident, we could perhaps dismiss it. Maybe he needed to buy a private island. Maybe he had a tax bill. Executive sales happen. But coincidence is a lazy man's explanation for market mechanics. At the precise same time Kushel was hitting the sell button, Another signal flashed across the wires. A director at M&T Bank, a significant player in the financial plumbing of the United States, also decided that January 21st was the perfect day to liquidate. He sold nearly $4 million worth of stock. Now we have a pattern. We have a top executive at the world's largest shadow bank and a director at a major commercial bank, both moving to cash simultaneously. These are the people who see the loan books. These are the people who see the credit delinquencies before they make the news. These are the people who know the true health of the consumer and the real leverage in the system. And their actions are screaming something very different from their public statements. They are voting with their wallets, and their vote is a vote of no confidence. This channel is not designed for the casual viewer who wants to be told that everything is going to be okay. If you are looking for comforting lies or the next hot stock tip to gamble your savings on, there are thousands of other channels that will happily feed you that illusion. You should go watch them. But if you are part of the fraction of the population that values uncomfortable truths over pleasant fabrications, if you want to understand the mechanics of the machine rather than just be ground up by it, then you are in the right place. We track the flow of money, not the flow of words. If that resonates with you, make sure you are subscribed. The algorithm hates this kind of information, so you have to actively choose to keep this connection open. Let's return to the evidence. The timing of these sales is surgically precise. In the world of high finance, you do not sell $22 million of stock on a whim. You do it because your internal risk models are flashing red. You do it because you understand that liquidity, the ability to sell an asset without crashing the price, is a finite resource. When the market is at an all-time high, liquidity is abundant. Everyone is buying, so it is easy for a whale to sell without anyone noticing. But when the mood shifts, when the panic sets in, that liquidity evaporates instantly. The door to the exit shrinks from the size of a barn door to the size of a keyhole. Kushel and his counterparts know this. They know that the best time to leave a party is when the room is still full and the music is still loud. If they wait until the fire alarm rings, they will be trampled by the crowd. So they sneak out the back while smiling and telling you to enjoy the punch. The contradiction here is visceral. The narrative is growth, but the action is evacuation. This creates a paradox that we cannot ignore. If the economy is landing softly, why are the pilots putting on parachutes? What is it that they are seeing on their proprietary dashboards that has convinced them to abandon the ship they are captaining? Is it a hidden debt bomb? Is it a geopolitical fracture that is about to widen? Or do they simply know that the valuations we are seeing today are a mathematical impossibility, sustained only by momentum and hope? To answer that, we have to stop looking at the ticker tape and start looking at the timeline. This isn't the first time insiders have pulled this maneuver. In fact, if we look back at the history of every major market correction, we find that the smart money never waits for the news. They make the news. The sale on January 21st wasn't just a transaction. It was a premonition. And to understand what comes next, we have to look at the last time the whales moved in unison like this. To truly appreciate the magnitude of this signal, we have to strip away the anonymity of the ticker tape and look at the man behind the transaction. Richard Kushel is not a name that appears on the front page of the tabloids. He operates in the quiet, air-conditioned boardrooms where the real decisions are made. As the head of the portfolio management group at BlackRock, his purview is arguably wider than that of most central bank governors. He oversees the teams that manage the multi-asset strategies, the fixed income allocations, and the equity trading for the largest pool of capital in human history. When you sit in that chair, you do not look at the economy through the delayed lens of government statistics. You see the raw data. You see the credit card swipes in real time. You see the shipping manifests before the ships leave the harbor. You see the corporate loan defaults before the bankruptcy filings are typed up. So, when a man with that level of visibility decides to liquidate $22.5 million of his own company's stock, he's not guessing. He is acting on a certainty that the rest of us are not privy to. This is the essence of asymmetric information. The market is often sold to the public as a level playing field, a democratic arena where the best ideas win. That is a comforting fairy tale. In reality, the market is a tiered system of information access. At the top, you have the whales like Kushel and his colleagues at M&T Bank. They sit in the control tower. Below them, you have the institutional algorithms that react in milliseconds. And at the very bottom, receiving the information weeks or months later, is the retail investor, the dumb money in Wall Street parlance. History is littered with examples of this exact dynamic playing out. And the pattern is always hauntingly identical. If we rewind the tape to late 2019 or early 2007, we see the same phenomenon. In the months preceding every major systemic shock, there is always a great migration of insider capital. They do not panic, sell at the bottom. That is what the public does. The whales sell into the strength of the rally. They use the liquidity provided by optimistic retail buyers to offload their risk. It is a transfer of wealth that happens in plain sight, disguised as routine portfolio management. Kushel's sale on January 21st is a textbook execution of this strategy. He is handing his bag of risk to someone else, likely a pension fund or an ETF that you hold in your retirement account, right at the moment when the price is highest. But why now? Why does the head of portfolio management at BlackRock feel the urgent need to hold cash in January 2026? The answer likely lies in the structural fragility that the soft landing narrative is trying to cover up. The banking sector, represented here by the simultaneous selling from the M&T Bank director, is the canary in the coal mine. Banks are the plumbing of the economy. If the pipes are about to burst, the plumbers are the first to know. The fact that a senior banking executive is selling in coordination with a senior asset manager suggests that the stress in the system is not isolated to one sector. It is systemic. It implies that the credit markets, the engine of all economic growth, are seizing up behind the scenes. When insiders sell in clusters like this, it effectively serves as a silent alarm. They are legally permitted to sell, provided they file the paperwork, but they are not required to tell you why they are selling. They don't have to hold a press conference to explain that they see a liquidity crunch coming. They don't have to warn you that commercial real estate valuations are effectively zero. They just have to file Form 4 and take their money off the table. The silence is the loudest part of the message. They are quietly securing their lifeboats while the captain tells the passengers that the ship is unsinkable. We must also consider the psychological aspect of this whale watch. These executives are not day traders. They are career corporate officers who are incentivized to hold stock, to show loyalty and alignment with shareholders. For them to break rank and sell such significant amounts, the perceived danger must outweigh the corporate stigma of selling. It is an act of self-preservation that transcends company loyalty. It signals that they believe the future growth of their own stock is capped, and the downside risk is now infinite. This brings us to the concept of the smart money exit. In every cycle, there is a distribution phase. This is the period where the smart money distributes their holdings to the dumb money. It happens slowly, methodically, so as not to spook the herd. But eventually, the inventory runs out. The whales have no more stock to sell, and they have moved entirely to cash or defensive assets. Once that transfer is complete, the support underneath the market vanishes. There are no more big buyers left to prop up the prices. That is when the floor falls out. That is when the correction happens. Swift, brutal, and unforgiving. The $22 million that left BlackRock on January 21st is likely just the tip of the spear. It represents the first meaningful crack in the dam. If we were to dig deeper, if we were to look beyond the names and headlines and stare directly into the mechanical guts of the market, what would we find? Is the liquidity really there, or is it a phantom? To understand why Kushel ran for the exit, we need to stop looking at the price and start looking at the plumbing. We need to examine the technical rot that is festering beneath the surface of these all-time highs. Because the charts are beginning to show something that the news anchors are refusing to talk about. Janan Len Tiep, Jang Koi Che Giai Juanba Chamba, Viet Manba. Dua Tren Styled Di, Whale Watch Jan Chon. Manba Se Kong Fan Tich Bio Jo Teo Kach Tong Tuong. So I. M-A-T-D. A-Tai Vo Jo. Toi Se Fan Tich Du Liu Duoi Dang Do Chan Kwa Ke San Mua. Hoje Lai Dao Vet Gihirut Tiandra. Doi Jai La Kich Banchi Tiet Chomanba. The Technical Deep Dive, Vacuum CTA, Script. Act 3. We are now going to descend into the engine room. We are going to look at the raw mechanics that validate Richard Kushel's exit strategy. If you strip away the polished press releases and look purely at the transaction data, a terrifying divergence emerges. In forensic finance, we call this the insider-to-retail spread. And right now, that spread is wider than it has been since the peak of the dot-com bubble. Let's look at the buy/sell ratio for corporate insiders across the S&P 500 for the first weeks of January 2026. Historically, a healthy market has a balanced ratio. Executives sell for personal reasons, but they also buy when they believe in their company's future. Today, that ratio has collapsed. For every $1 of insider buying, we are seeing over $50 of insider selling. This is not a market, it is a crime scene. The people running these companies are dumping stock into the open hands of retail investors who are buying ETFs on autopilot. It is a massive distribution of inventory, from the strong hands to the weak hands. But the most damning piece of evidence is found in the volume analysis. This is where the whale watch becomes undeniable. If you look at the rally that pushed the market to these highs, look closely at the volume bars. They are shrinking. The price is drifting upward, but the participation is vanishing. We call this ghost liquidity. The market is rising simply because there are no sellers left at these levels. Until now. Kushel's sale is the first stone starting the avalanche. When price rises on low volume, it is like building a skyscraper on a foundation of sand. It looks impressive until the first tremor hits. The order book is thin. The bids, the people willing to buy, are disappearing. I want you to pause right here and look at this reality. It creates a binary situation that cannot be reconciled. On one side, you have the stock chart at an all-time high, screaming that the economy is perfect. On the other side, you have the CEO of the money machine selling $22 million worth of that perfection. They cannot both be right. One of them is a lie. So, I have to ask you to make a choice right now. Who do you trust? The green line on the screen, or the man who built the engine? Go down to the comments section and type just one word. Write chart if you think the market is right, or write insider if you think the crash is coming. Pick a side, because history shows there is no middle ground when these two diverge. Let's get back to the data. Where is that $22 million going? It's not going into other stocks. It's not going into real estate. If we track the flows of institutional capital, we see a massive surge into short-term treasuries and money market funds. This is the cash bunker. The whales are effectively going to cash. They are parking their wealth in the safest, most liquid assets possible. Why? Because cash is an option on future volatility. When you hold stock, you are exposed. When you hold cash, you are a sniper waiting for a target. Kushel isn't just selling to protect his wealth. He is selling, so he has ammunition to buy your assets for pennies on the dollar when the inevitable correction flushes you out. This is the technical reality of a liquidity trap. The trap isn't that you can't buy. The trap is that you can't sell when you need to. By the time the average investor realizes the trend has turned, the whales will have already removed the bid support. The floor will simply vanish. The technicals are not just bad. They are mathematically set up for a flash crash. The leverage in the system, combined with this withdrawal of smart money liquidity, creates a setup where a 15% to 20% drop isn't just possible. It is the statistical requirement to reset the equilibrium. But here's the twist. A market correction of that magnitude doesn't just happen in a vacuum. It usually requires a trigger, an external shock to push the unstable structure over the edge. And while we have been focused on the domestic rot inside Wall Street, a much larger game is being played across the ocean. The whales aren't just worried about P/E ratios. They are looking at a geopolitical chessboard that is about to catch fire, threatening the very currency their assets are denominated in. The sell order executed by J. Richard Kushel does not stop at the boundaries of Wall Street. If we pull the camera back and look at the entire board, we realize that this domestic retreat is actually a response to a global siege. The $22 million exit is likely not just a bet against the U.S. stock market. It is a defensive maneuver against the structural decay of the U.S. financial hegemony itself. To understand why a giant like BlackRock would want to hold cash right now, you have to understand the geopolitical firestorm that is currently consuming the edges of the dollar system. While American media is fixated on the soft landing, the rest of the world is preparing for a hard decoupling. We are witnessing an acceleration of the bifurcated global economy. On one side, you have the G7 nations struggling with debt-to-GDP ratios that haven't been seen since World War II. On the other side, you have the BRICS bloc, led by China and Russia, aggressively moving away from U.S. Treasury bonds. This matters because for the last 40 years, the United States has relied on foreign nations to buy its debt. That demand for debt kept interest rates low and stock prices high. That mechanism is now breaking. When BlackRock looks at its global heat maps, they see this demand drying up. Foreign central banks are not buying U.S. debt. They are selling it to buy gold. This creates a vacuum in the bond market. And here is the terrifying economic law that links back to Kushel's sale. When no one wants to buy U.S. debt, the yield on that debt must rise to attract buyers. When yields rise, the value of stocks must mathematically fall. It is a seesaw. You cannot have high interest rates and record-high stock valuations simultaneously without breaking the laws of financial physics. Kushel knows the bond market is screaming danger, and the bond market is always smarter than the stock market. Furthermore, we must overlay the internal political chaos that is brewing in Washington. The U.S. national debt is compounding at a rate that is mathematically unsustainable. We are borrowing trillions just to pay the interest on the credit card. This creates a fiscal dominance scenario where the Federal Reserve loses control. They will eventually be forced to print money, not to stimulate the economy, but simply to prevent the U.S. government from defaulting. BlackRock knows this. M&T Bank knows this. They understand that before the money printer is turned back on, which triggers inflation, there is usually a deflationary shock, a liquidity crisis where cash is king. They are front-running that crisis. This is where the geopolitical web tightens around your neck. The soft landing narrative is designed to keep you invested in the system while the architects extract their capital. They need you to hold the bag. If the masses were to panic and sell alongside Kushel, the system would collapse overnight. So the silence is weaponized. The calm before the storm is manufactured. Now, let's bring this down from the stratosphere of geopolitics to your kitchen table. What does a geopolitical liquidity crisis actually look like for an American family in 2026? It doesn't look like a war movie. It looks like a slow, suffocating squeeze. It looks like your 401k balance dropping 20% in a month, erasing 5 years of your hard work, just as you were planning to retire. It looks like the interest rate on your credit card jumping to levels that make paying off the principal impossible. It looks like a grocery bill that continues to climb even as your assets lose value, a phenomenon known as stagflation. When a director at M&T Bank sells stock, he is effectively saying that he does not believe the American consumer can keep paying their bills. He is seeing the loan delinquencies rise. He is seeing the cracks in the commercial real estate market that anchors Main Street. He is seeing that the strong economy is fueled entirely by debt that is now becoming too expensive to service. The connection is linear and brutal. The geopolitical pressure reduces demand for U.S. debt. The lack of demand spikes interest rates. The spike in rates crashes the stock market and breaks the consumer. Kushel sold because he sees the dominoes falling in this exact order. He isn't waiting for the television anchors to announce the recession. By the time they use the R word, he will be sitting on a pile of cash, ready to buy back the wreckage of the companies you were forced to sell. This is the cold reality of the global game. The United States is no longer the only player at the table, and its chips are running low. The insiders are adjusting their strategy for a world where the dollar is weaker, debt is toxic, and buy and hold is a strategy for victims. The sale on January 21st was a vote of no confidence in the current stability of this global order. So as we stand here looking at the pieces, the insider selling, the technical breakdown, the geopolitical isolation, the picture becomes undeniably clear. This is not a random fluctuation. This is a controlled demolition of the soft landing myth. The smart money has left the building. The doors are closing, and the only question left is, what happens when the realization hits the crowd? We have gathered the evidence. We have analyzed the $22 million exit by J. Richard Kushel. We have cross-referenced it with the banking sector's retreat at M&T Bank. We have exposed the decaying technicals and the geopolitical vice grip tightening around the dollar. Now, we must synthesize these fragments into a verdict. This is not just a story about a few executives selling stock. This is a lesson in the predatory logic of the modern financial system. The market, in its current state, is not a mechanism for price discovery. It is a mechanism for wealth transfer. And specifically, it is designed to transfer wealth from the patient, uninformed many to the impatient, informed few. You must understand the physics of a sale of this magnitude. When a whale like Kushel decides to sell 20,000 shares, those shares do not disappear into the ether. They must be bought. For him to cash out $22 million, there must be $22 million of demand on the other side of the trade. Who is providing that demand? It is not other insiders. They are selling too. It is not the smart money. They are moving to treasuries. The demand is coming from you. It is coming from your pension fund, your index fund, and your retail brokerage account. The system needs you to be bullish right now. It needs you to believe in the soft landing with religious fervor. Because if you stop buying, the whales cannot escape. This is the liquidity trap in its most ruthless form. The financial media serves as the dinner bell, calling the herd to the trough, just as the butchers are sharpening their knives. The optimism you see on television is not a reflection of economic reality. It is the bait required to manufacture the exit liquidity for the elite. By staying fully invested in equities at these valuations, you are essentially volunteering to be the counterparty to BlackRock's exit. You are buying the insurance policy that Richard Kushel is selling. He is betting that the house will burn down, and you are betting that it won't. Given his position in the control tower, ask yourself, Do you really want to take the other side of that bet? The verdict here is that the smart money has officially declared the top. They have looked at the risk-to-reward ratio and decided that the upside is gone. The easy money has been made. What remains now is the hard money, the volatile, dangerous grind of a market correction. They are stepping aside to let gravity take over. This brings us to the most critical part of this investigation. What should you do? The instinct of the average investor is to panic or to freeze. Both are fatal. The predatory logic of the market relies on your emotional reaction. If you panic sell at the bottom, they will buy your assets cheap. If you freeze and hold through the crash, you lose years of compounding. The third path, the path of the predator rather than the prey, is active risk management. This is not the time for blind faith in the system. This is the time for defensive positioning. First, acknowledge that cash is not trash as the pundits claim. In a deflationary liquidity crunch, cash is a call option on every asset class. When the market corrects 20%, the man with cash is the king. He can buy high-quality assets at a discount. Kushel knows this. That is why he is liquidating. He is clearing his deck to prepare for the opportunity that chaos brings. You should consider the strength of your own liquidity. Can you survive a shock? Do you have dry powder ready to deploy when the blood is in the streets? Second, stop chasing the narrative. The news will always lag behind the price. By the time the headlines admit that a recession is here, the market will have already bottomed. You must learn to read the silence of the insiders rather than the noise of the anchors. Watch what they do with their hands, not what they say with their mouths. The sale on January 21st was a whisper. Soon, it will become a scream. We are entering a period of history where the rules of the last decade no longer apply. The era of free money is over. The era of geopolitical stability is over. We are moving into a phase of volatility, scarcity, and repricing. The passive strategies that worked in a bull market will be slaughtered in a bear market. The only way to survive is to adapt. You need to become suspicious. You need to become vigilant. You need to treat your capital not as a lottery ticket, but as a fortress that must be defended against those who are trying to breach it. The clock is ticking on this cycle. The signal has been fired. The executives are leaving the building. The question is no longer if the correction is coming, but when the trapdoor will open. You have been given a rare glimpse behind the curtain, a $22 million warning shot. Do not let it go to waste. This investigation is just the first step in decoding the shift that is underway. We are not just watching a market move. We are watching the dismantling of an economic cycle. The signs are accelerating, and the window for preparation is closing. This is not entertainment. This is financial survival. If you want to be ahead of the next move, if you want to know when the insiders start buying again, and if you want to navigate this turbulence with a map instead of a blindfold, you need to lock in right now. Hit that subscribe button and turn on notifications. We are building a dossier on the next phase of this crisis, and you cannot afford to miss the next briefing. The game is rigged, but it is only unwinnable if you play by their rules. When the architects of the system sell, the only winning move is to stop buying what they are selling. Stay liquid, stay sharp, and remember, in a world of infinite noise, the only truth is the transaction.